Let's go.
Thanks everyone for joining. For those of you who are new, welcome to Vyzer's weekly calls. As usual, these are not webinars or presentations. These are conversations that are designed to help us all think much more clearly about risk, about private investments, and everything in between. Now, today we're talking about investing where the risk is real. And we all know there's business risk. Some places around the world, companies deal with a whole other aspect of risk. And the reason I wanted to have this conversation is pretty simple because everyone talks about risk in investing, but we usually talk about, theoretical risk, valuations, rates, cycles. We don't often talk about what happens when companies are built and capital is deployed under real uncertainty. And to explore that, we're joined today by Shelly Hod Moyal. She's the co-founder and co-CEO of iAngels. And for those who don't know, iAngels is one of the most active early stage VCs investing in Israel. And I thought with exposure,
Apparently the most active,
sorry?
apparently the most active according
The
to
most active. All right, awesome.
I just received the report.
All right,
2025.
awesome. Yeah, and Shay's going to give a bit background, but they're exposed to more than 100 startups and been through market cycles. Full disclosure, they're also invested in Vyzer, so I have a personal affiliation to this whole conversation. Now, it's important to emphasize, I think this level of repetition and pattern recognition is exactly why we wanted Shelly here today. And just some housekeeping. This is an open conversation, so you're welcome to unmute yourself, jump in with questions. Also, this is not about politics and it's not a pitch. The goal is to understand how experienced investors actually underwrite risk and assist founders and think about outcomes when the conditions are really hard. And as I mentioned, we're going to be recording this. So, Shelly, thank you so much for joining us. I'd love for you to take a minute to share a bit about the background, about you, iAngels, and how you guys think about early stage investing. Just enough context so everyone knows your perspective and where it comes from.
Sure, of course. So I'm one of the founders of iAngels. We're an early stage investing platform and VC. So we allow people to invest under our platform in an equity crowdfunding structure. We're on the back end of that. We open SPVs for each company. And we also have a VC for people who want to invest alongside us. Our entry is always in the beginning. It's usually somewhere between pre-seed and pre-A. So we're usually investing in rounds that are around $3 million where we're leading them, and then all the way to the exit. Today we're managing $550 million. We've invested in over 110 companies. We've had 27 profitable exits. And we've really invested across the board. So we've been active in software across segments like health tech, agri-tech, pharma tech, renewable energy, cyber, fintech, pretty much everything you can think of except for medical devices and maybe biotech. So maybe I'll stop here and let you go ahead.
Yeah. So you guys have invested in a lot of early stage companies, right? And especially during this most recent conflict we've had in Israel over the past couple of years. When you look back across that experiences, are there any risk patterns that you like other investors tend to miss, and you have sort of found out that all right, these are things that we need to pay attention to that
In terms of
usually,
risk,
sorry?
specifically, you said specifically risk.
Yeah, I mean,
Mhm.
when we're talking about, yeah, the conflict
Yes, yes.
specifically.
So one thing that I really learned to appreciate is that we're always living in uncertainty. So that feeling when we're kind of cruising and we think that we're not in uncertainty, we're actually very much in uncertainty. And the first time I learned it on my skin was in Corona, in the COVID crisis. But then again with the Ukrainian war, and then again with our war with October 7th. And I've just come to realize that uncertainty is always there, especially with startups. And startups, they have a very high level of idiosyncratic risk, whereas the beta is a little bit smaller, meaning that we're very susceptible and we're very sensitive to our own risks, because usually in early stages you're really virtually investing in people. There's no business yet. Sometimes there's no revenues, no customers. So there are many different things that can go wrong, many uncertainties. But in terms of the market, we're less sensitive, but we are sensitive to the market because of macro factors that are related to fundraising, meaning that we're not necessarily correlated to the S&P per se, but when people are less wealthy or more wealthy, that influences FOMO, that influences our ability to raise capital for startups. And startups are very much reliant on raising capital. So in a sense, when you're investing in startups, you're always dealing with a great amount of uncertainty. I think what's special about the specific environment that I'm in is that people always feel the uncertainty, meaning that they never take the current situation for granted. I don't know if never is a big word, but from what I'm seeing, from my experience, the entrepreneurs in the region that I am in are very agile, are very used to adjusting to new situations where people might need to be absent, whether it's because of reserve duty or because of things that are related to COVID, or just in general, the world, which has been a wild place over the last couple of years.
Yeah, definitely.
Can I ask you a question?
Sure.
Yeah, question. So you mentioned risk and investors. I'm wondering if the investors perceive the risk as higher in those times of uncertainty than the actual risk of the companies themselves.
Yes, but it's always the case, isn't it? It's the same thing with public markets, right? Everybody's buying and everybody's excited and markets are going up and people get really excited and they want to buy. And usually that's the worst time to buy, and vice versa. So we're seeing something very similar. I have to say it's not just about FOMO, right? Because when markets are higher, then people are wealthier, they have more liquidity, especially if interest rates are lower. And when markets are lower and there's less liquidity and less exits and interest rates are higher, then it's not just about them, being afraid of the risk or uncertainty around investing, but a lot of times it's just they're really in situations where they can't invest or they don't want to invest because of it. So
Yeah,
yes.
we just went through that kind of thing, Shelly. Here, I don't know if your real estate market was the same, but I mean, we had, if you go back to 21, 22, even into 23, like a real estate deal, multifamily deal, it was really easy. There were just tons of them out there, lots of things exchanging, lots of LPs getting in. And unfortunately, that's when it felt the easiest to get in as a sponsor. That's when it felt the easiest to get in as an LP. Everything was going up. It had been for a while, but really that was the riskiest time.
Yeah.
And there's a lot of that capital, unfortunately, is not going to make it back to the investors. It's gone. People don't know it yet. Versus now, I wouldn't say across the board, but I'm starting to see the last half of 25, and I'm guessing 26, 27. Now is when people don't want to invest. The capital isn't there, but some of the deals are the best deals I've been finding. So do you find the same thing of like that different, like when it's harder to raise on the front side is actually, when you look at it, I don't know what your time frame is, 3 years, 5 years, 10 years out, is that vintage the best time or is that not the best time?
Yeah, absolutely. So the best vintages historically have been the vintages that followed a downturn in the market, 2008, 2000. There are certain years where you really see that the periods that people didn't invest at all were the best periods to invest. And I guess it's natural, right? I mean, when no one's investing and you're the only one around, then you have a lot more time to do due diligence. You have much less competition. You're much more selective. You're dealing with entrepreneurs that really want to be there when it's, when they're not there just because of everyone around them is leaving Google and Facebook to start a company. These are people that are really doing it out of a real passion and belief, because it's much harder to raise at these times. And you're coming in at a much lower price because of these things. So there's definitely an inverse correlation between heated markets and investment opportunities. I can share that, in 2021, it was the year when, as a platform, we raised the most amount of money, and I'm talking about tens of millions of dollars. And out of all the 13 years that I've been in business, it was probably our worst year of investing. It was the best year to exit. We had 13 exits in 2021, but almost every investment that we made in 2021, we could have got it by 80 or 70% cheaper just a year afterwards. And we were actually really lucky because we do a lot of due diligence. So there were a lot of deals that we simply missed because it was so competitive. We used to meet an entrepreneur, and 3 days later, they had like 3 term sheets, and then we just missed the deal because of it. So I certainly see it, and it's two sides of the same coin. And I think that in a certain way, we've seen the pendulum go all the way to the right in 2021. We've definitely turned the corner in terms of the lowest point. I think it must have been somewhere in 2024, which makes sense. I mean, we're always lagging. We're always lagging the public markets because we're, like I said, when the public markets are heated, people are wealthy. They start taking profits out of the public markets and putting into privates. So usually we feel the influence between 9 and 12 months later. I mean, if you think of 2021, the Cathie Wood ETF peaked in May, and then the S&P peaked in December, and then VC peaked somewhere in April, May of 22. So the same thing happens with us, just this time the lagging effect is longer because interest rates are still high and people were used to them being at zero for 10 years, like virtually zero. People haven't had exits yet. A lot of people got very excited and got very much into privates in 2021, and they haven't seen exits yet. The IPO window hasn't really fully opened. There are very selective IPOs. And people were also used to actually leveraging their portfolio. So I mean, you know this, but they leverage their portfolio in order to invest in privates where it doesn't make sense to do that right now because of interest rates. So there's much less liquidity coming in to begin with.
So,
Shelly, where do you see us in that cycle? Now and say like in 26, if the peak was 22, historically, how long does it take for things to kind of wash out, hit the bottom, and then make it, kind of that ideal 1 to 2, 3 year window for new investments?
It's really, it's really, really difficult to say right now because I think we're really seeing a divergence. First of all, as I said, private investors, they're not back yet in the same way as they were. On the other hand, the markets are going up. So that's signaling that we may see a wave, after people start realizing the returns from the public markets. And the other divergences that we're seeing is between technology and more specifically AI and cyber versus other sectors. So I think the people going back into privates is very much dependent on them seeing exits and liquidity from the projects that they already invested in, or new money coming in from people who aren't waiting for exits, which can happen. I mean, there is a lot of liquidity around the world, but there's also a lot of uncertainty and confusion as to where people should be investing right now.
Yeah, with the AI, I mean, one of the things I'm hearing is that in VC, especially in the pre-seed to pre-A where you invest, that people don't need as much money. They don't have to build out as big a teams because they don't need as many developers, coders, that kind of thing. Are you seeing that where founders need less money and aren't looking for as much early on, or is that not the case?
Yeah, so I'm absolutely seeing it, but I'm also seeing founders that didn't get with the program yet, meaning that they're still trying to raise kind of amounts that are similar to what they would raise in 2021, just because they have an AI component. But in actuality, to start a company today, if you're doing it completely AI native, is actually much cheaper than what it would be to start a company in the past. That being said, the existing companies are now facing existential risks, all of them. the growth stage companies, the early stage companies. I have quite a few companies that are working on two products in parallel. Have one product that is their legacy product that's servicing their current customers, but they have another AI native product that they're developing because they already understand that AI is going to eat into their market if they don't adopt AI. So that's a huge thing. That's a huge theme that's happening. I also have companies that have already fired half of their the developers, and at the moment are really focused on hiring only product builders or people that can basically build on Cursor and not necessarily professional developers. So the skills and what was needed in the past have changed, and they're changing faster and faster by the minute. So as an investor, it's very difficult to invest in this environment as a VC investor, that you know that AI is going to be big. You're positive about it. But on the other hand, it's very hard to invest, first of all, because there are already these kind of large companies, technology companies who are very much in it, or hiring talents at 100 million plus and dedicating a lot of resources. And also the fact that in AI, we're seeing a lot of these large companies like OpenAI and Google and Microsoft, that they're really dipping into the application layer, which historically used to be for startups. And so every company you're seeing, you're like, okay, but when is Microsoft going to be able to provide this? Or when is OpenAI going to be like, when are you going to be able to make these applications easily just using GPT? So I think at least I don't know about real estate, but at least in high tech and in technology, there's going to be a convergence. And I'm sure people saw what happened to NVIDIA, and people like Andreessen and VCs all around the world. I mean, they had front row tickets to it, and everyone would have been better off investing in NVIDIA stock versus investing in their portfolios.
Yeah. So hold on. We have a question here from Marom, and then I want to ask a question that's back sort of the fundamentals. But go ahead, Marom.
Hey, Shelly, good to see you. So for those of us who followed iAngels for a while, we know that there are tenets of how you've gone about establishing yourself, of operating with transparency, alignment of interest, partnership, and at a time of risk, at a time of uncertainty. Tell us about how that equation and looking for like-minded operators like Litan has tilted the odds in your favor at making it through risk and making it through uncertainty and operating that way.
Thanks, Marom. So actually, first of all, the experience of investing and being through these processes a lot. As I mentioned, we've invested in over 110 companies and invested probably more than 300 times because of the follow-ons in the companies and working with them and being through transactions and exits. And also with the help of people like Marom and Yochi, which really helped us navigate kind of understanding the personalities and specifically the ethics of the entrepreneurs. One thing that I find incredible about the environment where we're investing is the perseverance of the entrepreneurs. I remember there was a time, Marom, you might have remembered this, where we invested in an accelerator in California. And I remember a year later, they closed startups very quickly. And I was like, what? We just invested. You're closing after a year and a half? Because we're not used to that in our ecosystem. In our ecosystem, the founders will fight and fight and fight and really, really do it till the end. And sometimes at the expense of raising more and more rounds, which can result ultimately in the company not succeeding. But oftentimes, from our experience, the founders that persevere end up exiting. It might not be a very large exit, but it makes a difference in the portfolio. If you're investing in an entrepreneur that really hangs in there, I mean, for us, it was critical because we had so many exits that were 3x and 2x and 4x and 5x. And of course, we had a few that were 20x, and we had one recently that was a 40x. But those smaller exits actually make a huge difference in a portfolio versus a portfolio where you might have a unicorn, maybe 1 out of 10 or 1 out of 20, but all the rest close shop after a year and a half. So that has a huge effect on the portfolio, and it's something that I've grown very much to appreciate in the Israeli entrepreneurs. And so that work together with the entrepreneurs here, that reduces a lot of risk, making sure that you're investing in the right people. And when I say right, I mean people that are serious, that are professional, that are ethical, that know what they don't know, that know how to hire and retain people that are talented, that may be even more talented than them in certain areas. We're looking for those kind of people. So that's one thing. The other aspect of it is the research and the ability to kind of research markets and understand markets better just out of the experience right now, because of the investments that we've made into health tech, into cyber, into DevOps. We already have a lot of experience in these industries, and we have experts that we can consult with. So those are the things that that we've been paying specific attention to. Of course, there are more, but I don't want this to be too long. I can share that putting everything together has made us incredibly selective. I personally have not invested in a new company in 2025. And it's not because I haven't seen companies. I've seen many. Since 2022, I've invested in 6 companies. I've led 6 companies. And actually out of these 6 companies, 4 of them are doing very, very well. So I think that selectivity and that ability to kind of have patience and not rush into anything and stay disciplined and go through the checklist. And I mean, I think I mentioned this before, but it really saved us. Like the fact that we were very loyal to our due diligence and our process. We've missed a lot of deals that we shouldn't have done to begin with. And we've also saved a lot of money on the sidelines. It's very critical, especially if you're looking to make angel investments, that you leave at least 50% of the amount that you want to commit to a portfolio for follow-on rounds. Because in most cases, startups aren't successful in a linear pattern. It's not like, a straight line from the moment you've invested. In fact, in most cases, it's stochastic. It goes up and down and up and down and up and down. And so you really want to be there with funds if you're dealing with a team that you really believe in and a product that you believe in. And then there's an opportunity and a need to support and continue investing in these companies, which is often the case in early stage investing. And I can share with you, it's funny. It really makes me laugh that I look at Startup Nation Central, and for the last 2 years, we've been the most active investor in Israel. And I say to myself, how can that be? Because we're a substantial fund, but we're not. There are larger funds than us, and we've came to realize, and we saw this in our first fund, that we were one of the only VCs that actually came into 22 and 23 with around 50% of our funds in the fund. And what ended up happening is that we were instrumental leading or co-leading most of the follow-on rounds in our startup companies. And for some of our companies, it was critical. It was the difference between closing shop and, living another day to try to build a company. And actually one of these companies, which was literally about to close, we've invested in, then they're actually doing very well right now. So monitoring your companies and making sure that the entrepreneurs are thinking coherently about their product, because we're in a market where if we're wrong, then we have to be able to come up with another strategy or come up with another hypothesis quickly. So that's one thing. And the other thing is really saving money and making sure that you're able to follow on for companies that are both successful and companies that are still figuring it out.
Well, 1 second, Maroon. Thank you, Shelly, for that. I want to take the conversation for a second back to the unique situation Israel is and has been in. As a founder, like during a conflict October 7th, and not many people understand what it means to build a company in a country that everyone or most people, served and currently serve in reserve duty. Your team served and is in reserve duty. And then when this happened in October 7th, teams have entire teams or large majority of teams in small companies got, pulled in for reserve duty, and the rest who stayed in because of the craziness couldn't work exactly. And so it created a whole weird situation in Israel that adds the risk on top of the regular risk that a company or startup has ongoing. And I think that creates, first of all, most people aren't even aware of that. All right, they see distantly what's happening. Like you see Israel, you see Ukraine, you see other places around the world where there's conflict. You don't understand the companies that are building within that conflict. Now, I'm curious from your side as a VC investing in this environment, has your ability to underwrite entrepreneurs, or have you changed the underwriting process from the lessons learned during that period of like, all right, wait, these are new traits. I'm sure Marom could probably also contribute to his insight on this, but I'm curious what you think in terms of how has it changed your underwriting process for founders in this conflict environment?
We were actually very active in 2023. We actually made a lot of investments in that year. I never detached risk from reward. So when you talk about risks around the army and people being on reserve duty, with my knowledge of knowing how Israeli entrepreneurs work and the fact that we were being penalized because people were worried about the Israeli market suffering because of the war, while most of our companies, well, I don't want to say most, all of our companies are focused on the US. We're actually much more sensitive to the US market. So 2022, for example, when people were very worried in the US and software companies were cutting back on their budgets and sales cycles were much longer, was a bigger issue for us than in 2024, in the end of 2023. So for us, this was a period where risk was actually lower because people weren't investing, at least in the beginning of 2024, and the end of 2023. People weren't investing. So we had much more startups to choose from. We were able to do very long DD processes. So I had a company, one of the companies that I've invested in from a second fund. I did a 7-month DD process with them. I kept getting them coming back. I said, okay, try the pilot, come back to me. I want to speak with the person with the pilot. I want to speak with this customer. I want to speak with that customer. Let's see what happens next month. And this time, this buying of time, it reduces your risk substantially for someone who really feels comfortable in a specific market. And this thesis actually surprised me beyond my wildest dreams in terms of what the entrepreneurs that were there during this time, what they were able to accomplish, the amount of time that they were able to stick around with very limited resources. It was incredible. Because really we had 15 to 20% of our companies in reserve duty. We actually had quite a few companies that had half their team in Israel and half their team in the Ukraine, which was like the only two war zones in the world where, we had, complete startups that were in both these areas. So as I said, yes, there were risks. From my experience in these years, it was mostly delays. We had some delays in products. We had maybe some people in Europe that didn't want, to close contracts. Like Europe was a bit more difficult in terms of from a B2B perspective. But from a risk reward perspective, it was almost ideal. And as I say, it's always two sides of this of the same coin. When capital is easy and everybody just wants to throw money everywhere, it's probably a terrible time to invest. And when nobody wants to invest and you have all the time in the world to make decisions, it's very difficult for fundraising. And we hardly fundraised at all that year. It was impossible to raise capital from investors that year. But because we saved so much money from our first fund, then it was an incredible time to deploy. I don't know if that makes sense or if I
Yeah,
answered
yeah.
your question.
It
Yeah.
does. It does. Yeah, I do also want to tap into under like how do you like questions you ask founders now? Have it changed? Has it changed from sort of pre October 7th? Is it the same
Yeah,
process or is it different?
pre-October 7th, it was very common to raise money for 1 year. This is something, by the way, that our team has never liked. I mean, you probably recall this, Litan, from
Yeah.
our due diligence process back in the day. But for me, it's always been 18 months and above, and now it has to be 22. I stopped investing at the moment in anything hardware related, because speaking of uncertainty, that's where we really, we didn't see it coming. In 22, by the way, not the war. In 22, we made a lot of investments in agri-tech and food tech, in many different areas, and we didn't appreciate how sensitive these startups will be to interest rates, to supply chains, to plants that open and close, to the fact that all of a sudden, all the large companies who used to be supportive of innovation and startups, all of a sudden they don't want to do anything in innovation. And so these startups had to, go and be alone, basically. They were orphaned by the industry. And so in terms of risk, that was kind of my main takeaway from this period and uncertainty. Because to be successful as a startup, a miracle needs to happen. Like, you really need the stars to align. And when you're dealing with hardware and supply chains and ingredients and things that are less software based, then you need actually more than one miracle to happen for that specific startup to be successful. And the war in Israel didn't affect the entrepreneurs' drive as much as it affected, for example, fundraising. So fundraising has become very difficult all over the world, but specifically in Israel. So this made me, from a risk perspective, focus at the moment only on software companies, only on companies where I know that with my $2 million, those entrepreneurs will be able to build a product and potentially start selling to customers. Because that's my KPI as a VC. I need to get my seed stage company to A stage, which means I need to get them from a point of, let's call it a POC, proof of concept startup, to a product market fit startup. And today, I don't want to invest in companies where I know that to go to market, they're going to need 30 or 40 or $50 million and above. That I know that my $2 million will only get them to the point where they need to raise another $20 million just to get the product into kind of the next development stage.
Shelly, let me ask you about a different side of adding value as an investor, which is as a board member. And as someone, you said, we need to get them to, and that's an active role that you and your team play on a board. And what are some lessons, maybe for people who aren't in Israel, what are some lessons learned of startups built in war zones as a board member that you think generalize or apply to other board members and other board observers that are helping companies make progress from these times?
Lessons, I mean, I think managing the budget is very important. Having a plan B. Okay, what happens if I don't reach the milestone I thought I would reach by this date? This is really, really critical, because you create a budget and there's a revenue side and there's a cost side, and oftentimes the cost side ends up being higher than what you thought, and the revenue side ends up being lower than what you thought. And having that cushion, having that ability to adjust is very important. I think, you know, that's an important lesson. There are many others, but that's kind of the first thing that comes to mind in the context of a war. I think what we did very well was able to get people to hold the fort in general in Israel. Like, we knew that there were people that were on the front lines, and there were people here that needed to, you know, continue working, and there were people that, you know, provided support in many different ways.
I can
Shelly,
say,
you said that.
go ahead, Mike.
Okay, I was changing topics if you have something on that.
No, go ahead.
Okay, I was just curious. So you have 110 investments. You have a fund. You have SPVs that you make for each one, and you said that you've only invested in 6 since 22 and none in 25.
Personally, I meant personally, because
Right. So that's what I was curious. How does that work?
We're three partners, and in a typical year, we'll make on average 8 investments. So this year we made in 2025, we've made 4 new investments. 4 new investments.
And is it something where, as long as one of the 3 partners believes in the company, you create an SPV and then your members can join it if they want to? And how do you decide what goes into the fund versus not?
So actually, we're looking for companies only for the fund. So
Okay.
we're looking for the fund, and then if we decide to invest from the fund, we open it up to the platform. But we're not going to be like, oh, this isn't good enough for the fund, let's let our investors take a look and invest if they want. So everything that we feature on our platform is an investment that our fund is also invested in, unless it's something completely out of scope, not Israel, growth stage, but it's very rare, and it's transparent, it's communicated.
And how do you personally decide which of the fund? I mean, obviously, somebody on the team thinks that it's a good idea to go into it, or else you wouldn't put it in the fund. How do you personally decide which ones to invest in versus not?
No, we go through, we have a rigorous due diligence process where there are several phases. We start with checks on the market, on the entrepreneurs. We've also been working with Marome. Actually, all our startups go through a leadership assessment and an interview. So that's been very helpful, and we've been working on that with Marome. I think it's been for 12 years now, and really bringing up red flags, which we use afterwards to reference check with other people that know them, and some of the reference checks are also back channel. And as the due diligence progresses, we do deeper and deeper dives. We talk to existing customers, we talk to other investors and board members, and in the end, ultimately, we want to get to agreement. So there could be a situation where I'm less passionate about a deal that my partner brought forward. But this process of due diligence, of my partner trying to convince me that this is a great deal, and bringing in new information and meeting with entrepreneurs and getting to know the situation better, ultimately, once we're all feeling comfortable, then we'll make an investment for the fund. And then we'll offer, and if there's room, we'll offer it on the platform.
Yeah, Mike, it's very different. It's so funny that you talk with a lot of high net worth families in the US that are like big LP investors investing, you know, millions of dollars in private equity, real estate, oil and gas, who've never written an angel check or invested in a VC before. And then you talk about this whole new industry, and it's like mind blowing. First of all, how much overlap there is on one hand, like the processes, the IC or the investor communities and committees and all that. On the other hand, it's a very different, you know, strategy diversification. And it's really interesting to blend the two worlds.
Yeah, we really want to give our investors an opportunity to invest like a VC. That angel investors can actually invest like a VC. They can look at deals and see exactly the analysis that we've done in our investment committee. They can create a portfolio that's diversified. Because one thing, I mean, you mentioned something about risk. And the other day, I have an investor that invested in one company on my platform. And he said, and it was in 2021. So you can guess how that went. And he said to me, but you recommended this. And I told him, it's true. I made an investment in this company, But when I recommend something, I recommend it in the context of a portfolio. I'm not recommending any single investment as a, I'm not recommending any single investment as a definite winner. We're investing in early stages. So by definition, most of the early stage companies are not necessarily successful. I'm recommending it in the context of a 20 company portfolio. And what our platform allows is for accredited investors and angel investors such as yourself to build a portfolio of 20 companies. And so that's important, especially as it relates to risk, because people always talk about diversification in the public markets and in general and in ETFs. And so in startup investing, it's incredibly important because to be successful in a portfolio of 2 or 3 or 4 companies is virtually impossible. Not impossible, but very, very difficult. Very difficult.
I have a question back to sort of war zones and conflict, because this is always comes up, and every time you're any of us Israeli founders or investors are on a panel or talk with other people that aren't, and the Startup Nation and all those books, and I don't like. All right, so we went through conflict again and again, but you have other countries who've gone through conflict again and again. Why is our ecosystem built in a way where it facilitates entrepreneurship as much as it does, and you don't see that happening in other conflict zones around the world?
Because first of all, our conflicts are ongoing. Like we always have a conflict. So we're used to it. We're used to being in these life-death situations. I had a visitor coming. I think it was in the last so I had a visitor that came in the last Iran war, and I was like, oh, when the bombs come, when the missiles come, this we're just gonna run here for a second and hang out here, and then we after we have a couple of minutes and my kids are coming and they're like schlepping to the bedroom and they don't care and they're like, Mom, can I go out already? And you hear like boom 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 in the background, and he was shocked, like this is really how it is. And yeah, I mean, Israelis are used to wars, or we're used to being in like this situations, whether it's in the army or in our life, or whether we've been part of a terrorist attack. And resilience is real. I heard a few weeks ago this new research about adversity quotient, AQ, which talks about resilience, and it shows that people that have a very high adversity quotient, for example, people that live in places like Israel, they're able to hold several different realities, or they're able to hold complex situations at once and together. And that only comes out of experience and the need to survive. And on the other hand, also the need and desire to thrive. And so I think that this plays a huge role in our ability to deal with conflict, because we've been through them a lot. I mean, Israel has become the startup nation out of conflict. I mean, we became experts in water because we were worried that we're going to run out of water. We're in a very dry area. We don't have a lot of rain. We have a lot of enemies around us. So we built technologies to deal with this situation. Same thing with cyber, same thing with defense. These are technologies that we've built because of our conflict, because of our need and desire to survive.
Yeah, I love it. All right, if any last questions before we wrap up here? All right, cool. So we're at time here. We're going to wrap it up. Shelly, thank you so much for joining us today. And I love the open conversation and being very concrete about how you think about risk. For everyone on the call, we'll be sharing this recording, as I mentioned, along with Shelly's and iAngels' contact information and all the relevant links in the show notes. And as always, these weekly calls are about building better judgment. We're not here to sell anything, just how we think clear about investing. If you found it useful, feel free to join us live next week. Thanks everyone for taking the time. Thank you, Shelly, and have a great rest of your day, evening. We'll be in touch.
Thank you.
Thanks, Shelly.